Profitability measures and margins are important metrics to consider in equity analysis. A company's ability to generate a profit and manage expenses has a direct impact on the sustainable growth rate, competitive advantage, and value returned to shareholders. Operating margin is a measure of a company's profitability before interest, taxes, and restructuring charges. The ratio is composed of operating income divided by revenues and is expressed as a percentage. The operating margin is based on income statement line items and can be computed on a trailing 12-month basis using the last 4 quarters of data. Operating margin can be read as the percentage of revenues retained after expensing cost of goods sold, selling general and administrative costs, research and development, and other costs not including interest, taxes, and non-recurring items. A margin of 35% means that a company retains 35 cents of every dollar generated in sales before paying interest, taxes, and non-recurring items. Operating margin charts are useful to view a company's current profitability in relation to historical levels and through different economic cycles. For example, a company with an operating profit margin of 22.9% when compared to the 10-year median operating profit margin of 18.3% would imply that the company is more profitable now as it is contributing more of each dollar to the bottom line than it has in the past. Operating margin charts can also show the range of historical profitability levels. A tighter range may imply less overall volatility. Operating margin charts can also be used to compare one stock to its peer, industry average, or to a broad market index. Advantages of profitability metrics are that they are easy to compute and to understand. Disadvantages are that peer groups can be difficult to define and peer companies may not have the same cost structure. An investor might look for stocks with a current operating profit margin above historical levels or above peer levels. A thorough analysis would include other data and metrics as well. Cyclical stocks have a wide dispersion between peaks and troughs, making profitability analysis difficult. Investors must evaluate the current ratio carefully within the context of the economic or business cycle.